Okay, this problem is asking you to calculate a few things. This company's purchased a copier for $10,200, and they're saying that the residual value is $1,200. Residual value and salvage value mean the same thing, so whenever you see those two terms, they can be used interchangeable, residual value or salvage value. It says the copier has a useful life of 5 years and can produce 100,000 copies over its life. When you're doing these depreciation problems, make sure you're reading the problem to figure out which method you're supposed to be using to calculate depreciation, because remember there's 3 different methods. We're going to talk about the straight line method, the units of production method, and the double declining balance method. This first one we're going to talk about is the straight line method. And what they're asking you to do is calculate the depreciation for the first 2 years, right? We bought it in 2011, so they're wanting you to calculate depreciation expense for 2011, 2012. What's the accumulated depreciation at the end of 2012, and what's the book value at the end of 2012? So let me bring up my example. My example here says on January 2nd, this company purchased a new machine of $900,000, and the machine has an estimated salvage value of $100,000. Remember, salvage value and residual value mean the same thing, and it has an estimated useful life of 10 years, and the machine is expected to produce a total of 500,000 units of product through its useful life. And so the very first item says prepare the journal entry to record depreciation for 2016 using the straight line method. So you don't have to do this in MyOpenMath, but what it wants you to do is calculate the depreciation expense for those 2 years. So for the straight line method, the formula is, and I'm going to abbreviate here, straight line method equals cost minus salvage value or residual value divided by, cost minus salvage value is your numerator, divided by estimated useful life in years. So this calculation is going to give you the amount of your journal entry for each year. So because the straight line method, once you figure out this number here, that is going to be the amount that you use for every year. That's what straight line represents, is it's a nice even straight amount every year of the 10 years of its useful life. So if we plug these numbers in, you know that your cost is $900,000. The salvage value, it says, was $100,000. And then we're going to divide by the estimated useful life in years, so 10 years. So if we bring the calculator up and actually do that calculation, 900,000 minus 100,000 gives us $800,000 that we're going to depreciate, because we're going to have $100,000 left at the end. Divided by the 10 years is going to give us $80,000 of depreciation per year. So that's the amount of our journal entry. And with every single method, whether you're using the straight line method, the units of production method, or the double declining balance method, it doesn't matter which depreciation method you're using, the journal entry is always a debit to depreciation expense and a credit to accumulated depreciation, that contra asset. If I could spell, it would be great. So then it's just a matter of calculating the number like we just did. So now we know it's $80,000 a year. We can plug $80,000 in for the debit and the credit. So again, anytime you see a problem that asks you to record depreciation, record the journal entry, it's always going to be a debit to depreciation expense and a credit to accumulated depreciation. You could go ahead and fill those in. And then you just need to look at what method are you going to use to calculate the number for the journal entry. This one happened to say the straight line method. We bought the machine at the beginning of the year, so we can do the whole year's worth of depreciation. The other thing you have to be careful of when you're doing depreciation calculations is looking at the date that the asset was purchased, because you cannot depreciate for a month that you didn't own it. So let's say we bought this machine in March 1 instead of January 2nd, right? So this particular example that we have here, we depreciate it for the whole year because we owned it for the whole year. We bought it at the very beginning of the year. But if we had bought this on March 1st, then we would have only owned the machine for 10 months, right? We wouldn't have owned it for January and February. And so you can still do the same exact calculation, but then once you're done, at figuring out what the annual depreciation is, you would have to then take this $80,000, divide it by 12, right, to get the, to get the monthly amount. So it's going to be $6,666.67 per month. And we would have owned it for 10 months if we bought it March 1. So then you'd have to take the monthly amount and multiply times 10. So if we had bought this machine in March, then we could only depreciate it for 10 months that first year. So we would be debiting depreciation expense and crediting accumulated depreciation for $66,666.67, and this represents 10 months worth of depreciation if we had bought that asset in March. So just be careful when you're doing your depreciation calculations, if you, especially for the straight line method and the double declining balance method, be careful to look at the date that you purchased it, because you cannot depreciate it if you didn't own it for particular months. So you can still use the exact same calculation to calculate the annual depreciation, then divide that by 12 to get the monthly amount, and then multiply times the number of months you owned it. Okay, I'm going to delete this since it wasn't. Okay. All right, so with the straight line method, this will be the journal entry that you make every year for the next 10 years, because that's the whole point of the straight line method is it uses the same depreciation every year. So the depreciation for year 1, year 2, year 3, year 4, year 5, it doesn't matter. It's all going to be $80,000 for your depreciation expense. Requirement number 2 then says, what is the accumulated depreciation at the end of 2017? We purchased this in 2016, right? So we would have had $80,000 worth of depreciation for year 1. We would have made this journal entry year 1. And then $80,000 of depreciation for year 2, because we would have made this exact same journal entry December 31st, 2017. And so my accumulated depreciation at the end of year 2017 is going to be $160,000. So you can key that right in. And what accumulated depreciation represents is the amount of depreciation that is accumulated since you bought the asset. It's exactly what it says, right? Accumulated depreciation. The amount of depreciation that has been accumulated or over the life of the asset. And so each year, this amount is going to go up by $80,000. Depreciation expense, on the other hand, represents the amount that you estimated that you used up just for that particular accounting period. And since this represents 1 year journal entry, then that's the depreciation for that whole year. And so the expense part estimates the amount of depreciation you've used up for that accounting period. The accumulated depreciation just adds up or accumulates the depreciation since the beginning of time, since you own this thing. Okay. The very last part of the problem asks you to calculate what the book value is of the asset. And in order to calculate the book value of the asset, you have to take the equipment's original cost and subtract out the accumulated depreciation at the time. And that's how you calculate book value. So cost minus accumulated depreciation gives you book value. And so this is asking for the accumulated depreciation at the end of 2017. And we just calculated that our accumulated depreciation at the end of 2017 is $160,000. So we can go ahead and put that number in there, right? And then we just need to scroll back up to the top and get the original cost, because that's how much that asset is going to be put on the books for. We would debit the equipment and credit cash or notes payable, depending on how we paid for it. So $900,000 is going to be our equipment's cost. And the equipment is all, not $9,900,000. The equipment is always going to be recorded at cost. And so the book value in my open math that you would key in would be $740,000. So again, book value is always equipment minus the accumulated depreciation at the time. If it had asked us for the book value at the end of 2016, right, then this would only be $80,000 because we would have only depreciated it for 1 year at that point. The cost doesn't change until you go to get rid of the asset. It stays on the books at $900,000, but the accumulated depreciation will go up every year because that's the amount of, that will represent the amount of depreciation you've taken on the asset since the beginning of its useful life. So at the end of year 1, my book value would be $820,000, but at the end of year 2, it would be $740,000 because we would have taken $80,000 depreciation each year. Okay?